Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Thanks for tuning in as we celebrate our 10th year of podcasting. It's a big year. Some fanfare that's going to happen around it when we do actually mark the exact date that we are at 10 years, a whole decade of recording podcasts. A lot of people think podcasts are new and they're just stumbling upon them. I tell you what, after recording thousands of them over a decade, they're not new. They've been around for a long time and in many ways changed the way in which Australians invest in property, and we get a lot of kick and satisfaction out of that. My job is to share discussions, stories, insights with people right across the property spectrum to give a sense for how they're going about creating wealth through property and how you too could potentially use some of these strategies and ideas to shape the way in which you invest. Our guest today, he's been on the show beforehand, but he came in as a guest of the crew over at Finney Mortgages. He is a buyer's agent. We looked at some of the strategies that they were working on between the organisation and Finney with their clients. But I actually wanted to get him in the studio to get the real deal story of how he ended up doing what he's doing today. And he's come from a different background than many of you. He comes from investment banking, so don't hold that against him. I will. That's my job. Steve Ash from Property Strats. How you going? You well?
Yeah, no, I'm well. I'm just hearing 10 years of podcasting.
10 years of podcasting.
So, yeah, 10 years ago, I was in investment banking listening to the podcast. So there you go.
How did you originally find the Smart Property Investment Show? Do you remember?
Well, I was a reader of the magazine.
Okay.
So quite a few lunch breaks. I used to buy it every month and, kind of used to lap that up. Met a few sort of people that's still in my team. Well, when I say sort of partners, I should say, from that time. And then sort of, got into the podcast and just love listening to people's stories and learning for myself. So it was awesome.
I actually had in this studio about a week or so ago, the first ever guest of the Smart Property Investment Show on that very first podcast, a guy called Ross Lacane, who was a mortgage broker out of Aussie Parramatta at that time. So I had him in here, and he's now become a buyer's agent. Everyone's become a buyer's agent. He's a buyer's agent.
It's gone full circle.
Can't
beat us.
But it's really attracting. And I've navigated this space for 10 years, and all of those property investors who I used to see at all the different events, most of them now are buyer's agents. So it's a nice home for a lot of people. They obviously have a passion for property, yourself included.
No, yeah, absolutely. I mean, it is inspiring when you sort of hear these people come on the shows and listen to their stories, etc., and how they've managed to sort of grow. And it's almost a natural progression. Like I think we were talking just off air about sort of once you've scaled that sort of portfolio and you've hit your sort of goals, what do you do next? And a lot of us, that's the one reason I love being in Australia. It's very entrepreneurial here, and you're encouraged to give it a bit of a go. And for many of us, it's just a natural thing. Either go mortgage broking or buyer's agency. I suppose buyer's agency, no disrespect, mortgage brokers maybe a bit more sexy. You can go out there getting deals done. Get
to fly around and look at stuff and talk to people rather than churning through loan documents. Different skill sets.
Yeah, absolutely. I suppose we're not going into Vaucluse. We're going around Mount Druitt or whatever. Yeah. But
Mount
still,
Druitt's great. You still get some good fishes. The fish and chip shops out in the western suburbs of Sydney never take them away. But it's funny you say that. And I was chatting with Eva over at Finney, who you know, the other day, and she had someone join on a podcast, a Turkish lady who's been in Australia for a few years now, and we actually had a discussion, and you could probably resonate with this, and it's sort of picking up something you said. Australia gives you lots of opportunities. It's quite a forgiving place as well. Yeah. So if you arrive as a migrant, and most Australians at some point in time have arrived as a migrant, you can really make hay if you want to give it a red hot crack.
Yeah.
And you don't have a lot of structural limitations here that you may have in other places, including England, right? Like in England, you're sort of you're born in a particular area, you're brought up a particular way, and it's hard to sort of maybe inverted commas social climb, right? It's still very restrictive.
It is, especially in London, but it's all about going to the right universities. But that's kind of what you're encouraged when you're young. And I might have touched on the last podcast, but I was kind of brought up in just a normal middle class family, and it was just all about getting the best grades you could get. I didn't get very good grades, to be honest with you. But get to university, get into the best company you can, work your way up, and have kids, family. It's very kind of regimented, and that's kind of like hundreds of years of that. When you come over here, you kind of you sort of opens your eyes on what you can do, and you can leave that behind. And I think every step, that's why it's been so exciting. When I first got here, I bought a property within 9 months, and I did it with FIRB approval. So it's a bit risky. Probably shouldn't have done that.
Without a pre-approval, you just bought something.
Well, yeah, without pre-approval, I just went in. I didn't know what I was doing then. But it's sort of that was kind of like the light bulb that got it going. Funny enough, when I bought that property, I'd looked at about 50, so I had an idea of what value was, but still had no idea what I was doing. But I'd never have done that in the UK. Put it that way.
What are you doing? You can't do that. It's like there's a lot of reasons why you don't even think about it in the UK. I spent a lot of time in the UK. Got English family and stuff, and it's just built into people to run a particular line in life.
Well, it is. I think about all the people I grew up with at school, and when we left, everyone was just talking about the best company they get to, and a lot of them went into sales jobs in pharmaceutical companies or whatever. I went into health and fitness, I think, back then. Well, it was health and fitness because they said, oh, you're good at cricket. Maybe you just do that. So that was the career advice I got. And I look back on that and just, it's criminal. And now you've got the Kiyosaki books. I only read the Kiyosaki book a couple of years ago, but when I sort of read that, it's like, well, yeah, they're not setting you up at all for life back there. And then, but over here, you really are sort of encouraged to give it a go. And you're not having all your sort of moves judged a little bit. And if you do make a mistake, and I made mistakes in my property investing journey, then good. But one thing I have learned here is if you work hard, you're really given a fair go. And I worked my ass off and got my sort of grub state and able to get a couple of properties, and then I saw my money working for me, and then I was away at the races.
Here we go. So give me a sense for the size of your portfolio now, just to help shape the chat.
Yeah, so it's 11 million now.
Okay.
And so we've been, the business has been going about a year and a half now, so we're just about to do our second year's worth of accounts. I've got Manzur on the case. I know he's
your accountant, is he?
He is my accountant, yeah, sort of a few white hairs, not just probably yourself as well. Yeah. But yeah, we're getting ready for the big refinance, and so we're looking to go to level 2 in the portfolio now.
So you're going to give a red hot crack now that you've got a couple of years of trading, and the point here Steve's making is that if you go into business for yourself and you move away from having PAYG employment where you get a couple of pay slips and largely it's guaranteed, when you become self-employed, that the lenders get a bit jittery lending you money too quickly. So they like to see a couple of years of trading history to show that you're profitable and making money and doing all that sort of stuff. That said, though, there are lenders who will just need 1 year of trading history for new to business. But one of the biggest mistakes I see, and under Munzer's stewardship, you're probably not making this mistake, no doubt, is that people think they move into business for themselves. So it's just an ability to try and write off everything and show no profit. That might get one particular outcome, i.e. you pay less tax. But if you actually want to invest in property and create wealth through property or borrow money, banks actually want to see a little bit of profit, right?
Yeah, definitely. And it's and this is all a little bit new to me, so this leveling up, but yeah, and obviously we're in the second year. We're doing quite well there, but all of that 11 mil was actually built in just normal PAYG work. So I wasn't actually kicking the lights out in the amount I was earning, but it just goes to show what you can get to. But we got to that sort of level where we couldn't go any further, and so here is the way to obviously X up the income and then to keep growing the portfolio, because that's obviously always been a passion. Probably a lot of the people over the last 10 years would have had the similar sort of stories. They've got to a certain part, but they just, the portfolio is the passion. They want to keep that going, et cetera, and build wealth.
Well, let's talk about the portfolio and your work beforehand. We'll just go to a quick break, though. Stay with us back in a moment. Welcome back. Phil Tarrant, host of the Smart Property Investment Show, chatting with Steve Ash, property investor, who now has become a buyer's agent, which is a well-worn pathway now. So you were an investment banker. So you arrive in Australia as a backpacker, or did you arrive here with a job?
No.
And a dream.
So I was a backpacker in 2000, 2001, and I had a look around. I remember looking at some Bondi apartments there, but it was more just having fun then. And so I actually went back to the Blighty, lived in Reading for a bit,
Reading, wow,
the Reading Massive,
centre of the world.
Yeah, exactly, Ali G and all of that sort of stuff. And realised I don't want to do this anymore. So tried to get back to Australia, couldn't do it. Lived a year in New Zealand. That was awesome. And then I went back to the UK. It was in New Zealand I got exposed to sort of investment banking. So I worked on, but I think it's a funny story. Maybe you won't. But when I worked there, I just doing a sort of IT sort of help desk, and one of our clients was a company called Meridian Energy. And when I was at Goldman, we did the IPO for Meridian Energy about 10 years later.
Okay,
but
there you go.
They had a little commodities trading floor. So I started working with them. I got to know a little bit about it. And when I went back to the UK, I got a job at HSBC on the biggest trading floor in the world. And then that's when I really started working as hard as I could just to understand everything about, the industry, and that's kind of where it's gone from there. And so I did that for a couple of years. It was really good fun. A few of my friends.
So you're in London, working on a training floor, in the pubs every night.
In the pubs every night.
Yeah.
It was. I remember the
the
Sambuca
drill.
sort of at lunchtime. That was that was pretty crazy. But
So what were you doing on the trading floor of HSBC? Just trading commodities for clients?
so I wasn't actually trading. It was there. I was more kind of learning how the systems worked,
Yeah,
and
okay.
so the platform. So in the FX and equity sort of worlds, they have order management systems. So one was called Fidessa, and that was a big equities trading platform, and you have connectivity to markets, etc. And so I was an expert in that particular platform. And then and that's kind of how I built my wares back there in the UK. The natural progression there was to go into electronic trading, but for the next few years, when I came across to Australia, that's really what I kind of specialised in FX and equity platforms, and really knowing how they work inside out.
So did you get a job in Australia before you came out here, or you
No.
arrived and got a job?
No, well, this is a funny thing. So we had the Ashes in 2004.
Yeah.
It was about the first time we'd won in about 20 years. And then a few of my friends were coming out, and they said, "Do you want to come out?" So just got a sort of guest visa, and I came out, and we got swamped 5-0 with Shane Warne and Glenn McGrath's last series. But I thought, no, I'd really like to give this a go. If not, I'll go back to New Zealand and try my wares out there. But I tried every job under the sun, tried to get sponsored, and it was the last job I went for, and it's a Boston-based custodial bank called State Street.
Yeah.
They took a punt on me, and
Big outfit, State Street. Were massive.
they're absolutely massive. Yeah, that's I was trying to think one of the biggest custodians in Australia now. So they look after some of the big super funds.
Maybe explain to people what a custodian is.
Yeah,
That's probably
sure.
good for them to know.
Yeah. No. So custodians, so they're an asset holder essentially. So if there's a number of big superannuation funds here. They kind of hold them on the books. So if they, just take Australian Retirement Trust, for example, they hold a number of listed vehicles, so equities and bonds. And so it's the custodian who holds all of those assets, as well as the unlisteds, etc. And it's big business for them. They charge a clip on that. And State Street, they've been very aggressive. They're using technology to get more business, and so they're looking after 2 or 3 of the big super funds at the moment.
Yeah. So all the Aussies put their money in super funds. It goes into a super fund. The super fund gives it to someone like State Street and says, "Can you make this work for our investors to give them a return?" And then they go and deploy all the different decision making around that sort of thing.
Well, no, that's still done by the super funds, but they're just there,
They
just
hold it, make sure it's
just,
okay.
Exactly, and look at tax effective wares, etc. But there's a number of things. Also, the data that you get from the custodian, so you can make trading decisions on. So that's kind of what I was getting involved in towards the end of my career, taking very complex data and then just giving it to portfolio managers so they could actually make decisions on it.
Yeah, that's cool.
Yeah.
So State Street for a while, and then what happened after that?
So got into State Street there, and sort of that's when I started.
Is that when you started investing?
It was. There was someone on the. Funny enough, he was an interesting character. Looking back on it, but he'd made a couple of good investments in Melbourne back then, and he said, "Well, you should look at investing in property." So I took it on there. I'd seen my own sort of place had gone up then $100,000. Like he says, apartments don't grow. That unit was in a boutique block, and it did really well. And so from there, I met a really good broker who back then, he doesn't do broking anymore, but I learned a lot from him, and I was able to start going from there. But the one thing I learned, and it's a pretty big moment, this was before the GFC, so I was at State Street, during the big event, and before the big event, they were having Christmas party. Probably shouldn't say this, and they're handing out iPods back then. And then a few months later, the GFC hit, but I remember having a chat, and we were in the bar just around the corner in level 58, Aurora Place, I should say. Yeah. And someone was saying, I said I was just about to buy this property, and she goes, there's going to be a property crash, and this is symptomatic of the next 10, 15 years. I said, I don't think there's going to be a property crash. She goes, well, I live in Manly. I'm renting at the moment. It's about $700,000 a buy in Manly. It's going to be a property crash. You're going to lose all your money. And I thought about it, but I just thought, that's crap. A lot of my other friends were renting in Balmain and Bondi and all these other Poms. Obviously, going to be Bondi. But yeah, someone tipped me off to Kogarah. There's a fast train train line there, and then we got an oversized apartment, it's about 150 square meters with a mezzanine level, is about a K to the center, and that was about 150,000 cheaper than all of these other sort of apartments. And I just thought, no, it's not going to crash. I'm going to back what I think, and the rest is history from starting the portfolio.
Wow. And did you get canned from State Street when the balloon went up with the GFC?
No, we didn't. It was a really surreal sort of. So I used to work on the FX or looking at the electronic sort of trading on the FX desk then. I remember getting in at 5, and it was around, I don't know, it would have been the day that Lehman went under, or weekend that Lehman went under. And State Street stock price went from 47 down to about 9 in a day. And it was, and just seeing like the FX guys, they're all generally very, very confident people. And it was like, what, you could just, everyone was sort of what,
Shell shocked,
thinking what's going to happen. And then kind of like the news coming out of the London and New York, where people were turning up to work and their passes weren't working. That's how you knew that, you weren't going to, you weren't going to be around for much longer. But there was only about 2 or 3 people who actually, at that point, got canned from State Street in Australia, well, in the global markets division where I was working.
Yeah. That cohort of people that operate in and around financial markets, wealth management, funds management, all that sort of stuff. Interesting folks. We do a lot there. We own all the media assets around that. But I got a really good mate who sort of similar story to you. He's sort of big in FX. He did his time. He's an Aussie bloke. Yeah. Did his time over in the UK. FX. Now he's got a senior FX role up in Asia for a big Asian bank. And I must have for years just debated with him investment strategies, right? And him and all his mates who work across that sector is that they'd never invest in property. They'd tell you every single reason why you shouldn't be investing in property and be doing options and swaps and trading this and trading that and blah, blah, blah. You always had something on the bubble, would never, ever touch property. I'd be like, going, mate, like, for years and years and years, we finally got him investing in property and now he loves property, right? He's absolutely killed it. But I would say that you were probably quite a contrarian within your social peer group at work for prioritising property as an investment class over all the other assets the other guys are probably spending their dough in.
No, definitely. And like towards the end of State Street, like, I mean, it was a good time. It was a good time to be in Australia. There's a lot of it kind of like, I suppose, migrants working at State Street, a lot of people from Ireland, England, etc. And they were just going out and having fun. But I just realised, okay, how much I was earning. It's never going to cut. I was never going to get where I needed to get to. And it was really sort of seeing my place grow 100,000 like 18 months or so that really hit the light bulb and on for me. And sort of when I moved on to other places, particularly, so I moved on to Goldman Sachs and worked there for about 6 years.
So Goldman Sachs, investment bank, essentially?
Yeah. So I was in the securities trading division there, equities, and we did a bit of futures there in electronic trading. And but again, I think everyone's too clever for their own. I don't want to offend of my.
I know the type. They're cool. They're big. They're big people. They can hack it.
Yeah, so I had this futures guy, and he was quite experienced. At the end, I clearly remember him saying to me, "You were a brave guy going long property." And this was just as I was leaving Goldman. I'm like, "No, I'm not. It's just a no-brainer."
But just the language going long on property, like I never hear property investors talk that language. I've never heard anyone say, "I'm going long on property."
Yeah, I suppose so. Yeah, you're not going short on a property, that's for sure.
No.
But one of the stories, and this might offend someone, but there was one of the head guys, an MD, really smart guy, a good guy. He's running a fund now, so he's an extremely smart guy. But it was around that sort of time when the Big Short was coming out, so the aftermarket of the GFC, so talking about subprime mortgages, etc. And then Australian property prices in Sydney had done obviously really well for the first half of the 2010 to 2015. And he was like, "There's going to be a massive property crash." He had a pad in Darling Point, and he sold that because he was adamant. He wanted to go short the Australian property market. And I remember with the guy I worked with, and he was like, "Oh yeah, he's a clever guy. I'm going to do that." And I said, "Don't be stupid. There's no way it's going to crash. Come on." And so I probably saved him some money. He was going to flog his Lane Cove property.
God.
But yeah, just imagine that.
So he sold his fancy place and it probably kept going up in value, no doubt.
Oh yeah, it did. Yeah. It did. It would have done. Well, he's Starling Point, isn't it? Yeah. So imagine that. But I'm incredibly smart with equities, but probably too smart for his own good when it came to property.
And you find it in that cohort, right? Because they'll overanalyze. Everything can.
Yes.
Property as a as an investment class, it's for guys like me, I'm not particularly bright. It's simple to understand, right? And if you start dabbling in equities and commodity trading and FX, all this sort of stuff, like, it's a different world, right? And most people should be cautioned to stay away from that unless you really know what you're doing. Like it can be an easy place to lose your dough. It's also a good place to make a lot of money.
Make a lot of money, but that bet that Warren Buffett had, I think it was that index fund will outperform 95% of hedge funds, and someone took him up on that bet, and Warren Buffett took the flowers on that one. So that just goes to show how hard it is. If the hedge funds are struggling, it's pretty hard for the layman out there to sort of outperform.
It can be. So your peer group, were you the only guy really going heavy in property?
Yes.
Yeah.
There was my manager back then at Goldman. He spoke a little bit about doing it, and I actually talked to him. So at that time, I don't know if you remember, everyone was going gaga over mining towns.
Yes.
In 2010 and 2012, and I remember it was actually your sort of competitors in Australian Property Investor magazine.
Yeah.
And their top three investors, one was like in Port Hedland, second guy was Moranbah, I think the third one was Gladstone. And they were seeing the yields like it was 1,500, 2,000 a week in Port Hedland.
Yeah, and we were cautioning people saying,
"Oh, it's crazy!
Don't touch it! Don't touch it! Don't touch it!"
Yeah.
I remember the headline was Moranbah collapses as and all these people. If you got in there early and rode it and sold out at the right time, you could have done some good dough. But there was so many inverted commas mum and dad investors stuck with, and probably are still stuck. With properties, the properties in those locations still 15 years later, negative equity, and holding on to it with very poor yields.
Well,
it's absolute madness.
Absolutely destroy them. Actually, when I do talk to the accountant, every now and again, you still hear the stories, and they're still kind of struggling. Some clients back then, but I talked him out of doing it. So I did one thing good there, and just buy boring properties. And the funny story was one day I was looking. I just bought a property in North St Mary's.
Yeah, great spot.
And that's good. 240,000 that was. And I was looking for the next one in Lethbridge Park. So it doesn't get any better than Lethbridge Park. And I had it on my screen, and a couple of guys. One guy was a vol trader, sort of trading volatility. 8 screens, and he turned around and he saw me looking at this property in Lethbridge Park with graffiti on the wall and everything. He's like, "What are you doing? Like, you're crazy." I actually didn't buy that property because of that. So I kind of wish I'd never have actually got that on my screen.
Sounds like it would have been a good buy. Right?
180,000 that was, I think.
And sort of thinking back to those times, you can put your money into the system and let it trade, but the beauty of property is leverage.
Yeah.
And no doubt that was probably didn't hit the discussion points. 180,000 bucks in Lethbridge Park to get into that, you didn't need a lot.
No, it's much easier to borrow them, wasn't it? You didn't have the APRA buffers there. You could do the 90% lend, extract that back out, in a few months, go again, and
103% mortgages. You do everything.
Glory days. Yeah, absolutely. The only regret was I probably could have kept doing that, but because I had that comment, it sort of made me reevaluate a little bit, and I probably didn't we've all got stories where we have regret, but still we did okay, but probably would have gone a lot harder had that not happened.
Do you reckon you went hard, or you could have gone a lot harder?
I could have gone a lot harder, yeah. So obviously your LVR has got to be quite high when you start, and I was always a little bit conservative. My wife, we always just did it on my income, but sort of like I suppose my contemporaries around then. My new broker, he does a bit of my loans now, Michael Shah. He went really hard, and but I didn't push it as much as I could have done then. And but when you're really busy at work, there's a lot to do at the weekend, etc. But we still managed to get it to about 3.5 million around that time, and I'd set out a plan at that, and we kind of knocked it out of the park in about 2015, 2016. So initially it was paying off our mortgage in Balgham Hills and then getting 2 million in equity. And we'd managed to do that, and the plan was to divest that and then get passive income. But then obviously your plans change. I was still very young then, so
things change. You start off with this plan of that's what we need. You go, not enough. No, it happens to us all. But and now, like, back to the point where you're getting ready to refinance to go again. Are you going to go hard? Like, knowing what you know now, where do you sit in your sort of risk appetite for really pushing the boat out?
I think we'll just keep an eye on things. I think we'll always try and keep that LVR no more than 50-60%.
Okay.
But you go into a different sort of lending now. So you can do more low doc sort of loans. So maybe because we're going to extract quite a bit of equity from the portfolio. I mean, our LVR is about 40% at the moment.
Okay.
So we've got about 2.5 million we can extract there.
Wow.
And then we can go into low doc loans or something like that if we want. We're thinking about doing commercial. Look at blocks of units. We talked about that last time. I was looking at one in Newcastle last night that looked pretty good.
A block of units?
A block of units, on a Torrens title, which, very close to the centre there. It's off market. That looks a cracker, but something like that's going to be a little bit different.
Yeah, okay. And that's the exciting stuff where if you've got that sort of dough to deploy, you can do a fair bit of heavy lifting, right? With that sort of capital. Yeah. Rather than you get beyond sort of just buying sort of meat and potato type properties in the burbs, which is just going to give you capital growth. And all investors get there. It's where you start. It doesn't necessarily be where you finish. So you're at Goldman's. So you left there to do nothing, or you left there just to what was the game plan?
So we're in Melbourne for about 9-10 years. I love Balcombe Hills, but I'm a POM. Obviously, I've come over here.
Balcombe Hills is the centre of Sydney, mate.
Centre of Sydney.
Property's done well out there.
Property's done really well. We sold ours a bit too quickly there. Actually, we sold it for 1.3 million, or there and thereabouts. And then we moved down to Melbourne. Goldman let me go down to Melbourne, and we just wanted to be near the beach. So I love my golf, and so I joined a really good golf club down there. We're in Mount Eliza on the peninsula, and that was the idea, just to enjoy life a bit more, go and see some, what Australia has to offer, have a bit more lifestyle. We had some pretty good buffers in place. It was doing okay, and then. At Goldman, one of the things that finished me off at Goldman, was Brexit, funnily enough, and so I was there on the trading floor. Got there because I was in Mount Eliza. I had to leave the house about sort of 3:30, 4 in the morning to get into the city.
Wow, that's a big commute every day.
So yeah, I mean, it was about an hour and a half. But in that day, because it was going to be a big day, we had to get in there early. And then Brexit went the other way. They obviously voted to sort of leave, and then the futures markets just went crazy. And I was on the desk with people, and it was crazy stress all day long, and I didn't leave my seat. I got there about 5:30, and didn't leave my seat till about 10. And then after that, I got home and thought, I don't want to do this anymore. And so we were having a look around, and obviously the property portfolio was good, but I thought, what would be a good asset? What would be an interesting sort of industry to be a part of? And one of our big clients at Goldman at the time was Australian Super. So Australian Super was a merger of 5 industry super funds, and I thought that was a good sort of bet to go in there and start. Just taking it a bit easier. I used to equate it to, you ever seen American Beauty when he quits his job and starts flipping burgers? Yeah. And so that was my way of flipping burgers and then focusing on the property portfolio. So that was the idea. So
you had a less stressful role. You could probably do 9 to 5. Yes. Some flexibility, all that sort of stuff.
Yeah.
No responsibility, a lot less accountability.
Yeah, absolutely. Yeah, I remember the guys at Goldman, they were taking the mickey, saying, those guys just leave at 4. Yeah. And that's it. And I was thinking, well, that's brilliant. That's exactly what I want. I want to enjoy life a little bit more. And that's actually how it was. So it was good. But and so we did that for about 2.5 years. It was really learned a lot about the buy side. So the institutional on the other side, and that was good. But my wife didn't settle in Melbourne, so we then made the move up to Brisbane.
Okay. Is your wife English or Aussie?
Chinese?
Oh, okay.
So we've got a good, doing well. We're in Australia. My son's Australian. I'm English and she's Chinese. Good household.
So it's a real modern Australian family.
Well, it is. Yeah. Dinner time's interesting. Absolutely.
I'm sure you can mix it up a little bit. So while you're working inside a super, and so. Would you say you were financially free at that point? Like, if you weren't working, would have you been able to? Well,
we didn't have enough passive income to sort of call it quits, but I could have divested and probably got about 100,000 a year if we wanted to. But around that time, I was looking at it and thinking, well, the portfolio value now is about 3.5 million. I'd like to just keep that going. The value of compounding. If it just goes up 10%. I'm earning a lot more than the head of the division where I was working, so I wanted to keep it going. We bought another property. We had 2 in Logan at that particular point, which we put apartments on, and then we bought one in.
You put apartments on.
Oh, sorry. So it was zoned. It was in an area in Logan Lee.
Yep.
So close to the station. It all got rezoned to, I think it was LMR2, and so you could actually build up to 3-4 levels, I believe, in high density. And so we got 2 properties side by side on about 1,600 square meters.
Wow.
And and we could, and we're still holding those now. But that was always going to be potential mill ticket down the track.
Yeah. Okay. So you started really getting quite tactical, the portfolio with a view to grow from an equity point of view.
Yeah. And I think at that particular time, I still sort of in that mindset, that English mindset, sort of, work for a company. And I thought, what safer company is there to work for than superannuation funds? These areas are just going to get bigger and bigger. Yeah. People's contributions were just going up every year, and Australian Super was about 120 billion funds under management there, and now it's 350 or something.
It's crazy.
So it just seemed okay. I can just take it easy, earn decent money, work-life balance, and then I just keep growing the portfolio. APRA then kicked in around 2016, so. Then I got a bit of a rude awakening. It's not as easy as it used to be, going back to those days we were talking about a second ago.
Yeah, and this is putting buffers in place. So, they tried to slow down investment lending, growth in investment lending, and there was too much of it. So they thought, it's 2 to 3% buffer. So serviceability got harder to slow the market down, and there was some consequence and impact from it. Yeah. So, so you left working in super to set up a buyer's agent.
Yeah. Yeah.
So let's chat about that. We'll just go to another break. Stay with us back in a moment. Welcome back, Phil Tarrant, Smart Property Investment, chatting with Steve from Property Strats. Now, good journey, Steve. So investment banking, then working inside of super on the buy side, sort of different pace, a bit slower, let you think about stuff. So why did you leave doing that to set up a buyer's agent company? Was it just it's time?
It's a good question. So I moved from Australia, so went to their biggest competitor, really Australian Retirement Trust. Okay. It was a merger of 2 super funds. Yeah. And I decided to start pushing myself a bit more at work. It's kind of in my nature. I can't help myself. And when we did a big project at the end, and then we got that finished, and at that time there was some shenanigans that happened there. It's a lot of politics, as you can imagine, in super funds, and some pretty nasty stuff happened there. And that's really when I took the brakes off the portfolio. So we're about 3.54 million in 2019. And then we just went on a spree. We did a complete refinance, and then we kind of built that portfolio up to about 7-8 million. Okay. Bought really well. And then
did you leverage up to 80% on everything at that point?
No, only about 60-70.
Okay.
And but we got into the right place at the right time. We bought heavily in Brisbane in 2019 and added to what we had there. Then we moved across to Perth in 2020. And bought 4 properties there, and then I bought another one in Logan Lee. So I've got 3 in a row now.
Oh, did you buy the next door to that place?
Yeah.
Wow.
So we've got 3 there now.
How did you do that deal?
I bought that on my own. That was just looking around what was out there, and luckily it came online.
As you just go, I've got to get that.
Yeah. Well, it wasn't. So I went there. I paid a little bit over the odds just to get it, but it was worth a lot more to me.
Did they know you'd owned next door?
I tried to keep it quiet, but they actually looked me up, and the agent, and they
sods.
Yeah, they're buggers, and but I was still able to get it at a decent price. The funny thing, I thought I paid way too much for it, so 685,000. It's now worth 800 on its own. So there you go.
So you control 3.
Yeah.
Are they houses?
Yeah, 3 houses on 2,400 square meters. Yeah, they're side by side, all flat.
All zoned.
All zoned, 400 meters to the station. Absolute gold.
Okay.
Yeah.
So you just hold on and sell it to a developer?
I think my wife just keeps wanting to sell and then buy somewhere in Noosa, but we'll see. But at the moment, I think we'll just hold it. I think there could be some rezoning that happens there. As you know, Southeast Queensland, it's on the pod a lot. You know, how well that's just going off. And Logan's obviously right halfway between. Well, not halfway, but it's a good way towards the Gold Coast. So,
yeah, okay. Oh, that sounds pretty cool. That's exciting to have that. If they keep coming available on either side now, would you talk about risk and sort of condensing all your capital in one place? Would you buy more on either side, or 3's enough?
I'd probably get one more, I think. If it did come up, but I think that's probably enough. I would like a bit more exposure to Melbourne, because I think there's a lot of value down there, but maybe one more. I can see a bit of value there. Also looked at the properties around the back, and someone's built a new house around the back, so that
sort of stuffed you there.
That stuffed me
because if you can get double street frontage again, it's
It's even more.
Yeah,
Exactly.
Yeah, it's a game of monopolies. So, language that would be used in and around sort of insto funds management world is portfolio construction.
Yes.
So you must take that sort of lens when you're looking at building out your own portfolio and also other people's portfolios.
Well, it's critical. So, if you look and really it's all asset allocation. It's funny enough, I was listening to a bit of crypto stuff. I won't go into that about asset allocation there, but really that's kind of the secret sauce in any sort of investing. So if you look at kind of what Australian Retirement Trust and Aussie Super are doing, they're kind of looking at what sort of asset is looking overvalued or undervalued.
Yeah.
And let's just say equities are overvalued at the moment and they're 60%, and they'll reweight that down to say 50 or 40% and maybe increase more defensive products like fixed income or something. So if we look at that from a property portfolio point of view, obviously we're in one asset class here. I suppose you could mix it up a little bit, but I look at the capital cities and you could put regional into that mix. I'm not a big regional sort of person. But it's if we kind of take that same analogy and look at Sydney, Melbourne, Perth, Brisbane, blah, 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 you can see the undervalued sort of area at the moment is Melbourne and to some extent Sydney and the area surrounding Sydney. When I say, obviously, Sydney's expensive, but it hasn't done a lot. Yeah. And there's opportunities there. So you almost want to tilt your portfolio. That was a big word in the super funds to go long. I'm using all of them now.
So what do you mean by go long? Means that do more of?
To do more of. Get more exposure into those areas that are undervalued, like Melbourne and Sydney. Yeah. And so here, like again, going back to the equities analogy, buy more equities here, buy more Melbourne. So we know that Perth, for example, has done really well over the last few years. So you don't want to keep buying in Perth. There might be it might do quite well in the next.
So you want to go short?
Years.
You want to go short on?
I'm not too short in Perth, but maybe if lending's a problem and you can't keep going, might be worth looking at maybe cashing one in if you've got 2 or 3 there, and then sort of recycling that in. I generally don't advocate doing it, but obviously with a lending environment, sometimes recycling is needed. Yeah. So that's kind of how I'm looking at portfolio construction for myself and for clients.
Which is the right way to view it. And you could say that real estate is one asset class. Well, there's a lot of different asset classes inside of that. Commercial resi, there's 2 big structural changes. You know, and then within residential, you got houses and units. Yeah. And you've got different states, so you got metro versus regional, and even down at a geographic level. You say, Sydney's a capital city. Well, there's umpteen number of different markets in Sydney, and they're all moving at different speeds. I saw a piece in a paper just the other day of like places like Manly and whatnot have really come off quite a lot, where you've got areas out southwest Sydney which are firing along. So there is, you can have layers of diversification just in and around Sydney in so many different ways, and you can even diversify on how you choose to hold the assets, the structure you have it in, and or whether it's a capital growth or a cash flow. So all these things are different applications of diversification.
Markets within markets.
Markets within markets. Yeah. Streets and streets can change, right?
Well, exactly. There might be housing commission in one sort of street, and go on in other sort of areas, but 100%.
And even 2 houses identical side by side may present different value. One might be zoned differently. One might have an easement. One might have something or other, right?
Exactly. There's so many things, so you can really break it down from a micro level in so many ways. And you're dead right. I was looking at some numbers just before I came on and looking at sort of how properties performed, and I'd see Melbourne's down 1.7% according to PropTrack data. But we do know that there's markets within markets that have done really well. But then, to your point, some assets that are really killing it. So
I'm looking to buy Melbourne at the moment just to get into there. We did that big Fast 50 report recently, so I'm gonna get into one of those suburbs. I'm still working out which one. So watch this space. But
Fast 50. Excited to know where you buy.
Well, I'm sure everyone else is, right?
Everyone's getting ready.
Everyone's going, hey, I've chosen this suburb. It's the place to be. Get a call from. Okay, you can't do that, Phil.
Market manipulator.
But it's all. But the thing is, that's the point, right? It's all the information is out there. It's what you choose to do it, and you got to have a crack.
Yeah,
right. Like you can have all the information in the world, but unless you go, okay, I'm going to buy that and get in the market, and that certainly sounds like your story, where it sounds like there was quite a lot of naysayers and a lot of reasons why you shouldn't have been doing what you're doing in an environment where property investment wasn't traditional. But no doubt you perform better than some of those other guys and girls.
I suppose I'm in the studio with yourself at the moment, and I'm walking around Sydney this morning, and I'm sort of taking it easy. So you would say that, but the amount of times, and you would have heard this yourself, like and what we're going back to, there's going to be a property crash. Shall I get in now? Prices have grown too much. If you have like $1 for every time you hear that, but it's those people who take action, and it's just the rules are a little bit different now. So going back to sort of that macro level and investing in Melbourne, we all know the big problem with Melbourne is it's a bit of an investor unfriendly state, but then the yields aren't that great there either. So it's the portfolio construction then becomes really important in that particular regard.
So what do you like particularly about Melbourne?
Well, it's more that it's the value there and the contrarian play. So there's a few things really. It's you're getting properties at land value almost in some locations. Obviously, some are a bit more low socioeconomic, but really that sort of value play there, which is good. I think I know the disparity between Sydney's never been bigger. I think it's 41% of a discount they're trading at Sydney prices. So. Yeah.
There's something fundamentally wrong there when
it is fundamental.
Sydney, Brisbane, Adelaide, and Perth median price is higher than Melbourne, which will be Australia's, maybe already is or will be our biggest city by some degree.
Yeah, I think I was reading the other day it's going to be 9.2, 9.4 million by 2050, and at the moment it's 5.2 or 5.4, something like that.
That big, is it?
That big, yeah.
By 2050.
By 2050.
25 years.
Yeah. So you think, exactly. And like you said, it's about fourth or the fifth your kind of largest median at the moment, behind the likes of Brizzy, Adelaide, I think even Perth. So it's crazy. There's even, if you look at regional areas, like, and I'm not a big person, obviously they perform well, like places like Townsville. And there's areas where you can get prices or houses in Melbourne cheaper than Townsville, in my mind, and that makes no sense.
So something's not right there.
No.
And it's a moment in time, yes. The current government there and the previous government maybe haven't made the right decisions to place Melbourne in the right place for Melbourneites or Victoria in general. However, us property investors sitting in the wings will go, well, something's up there. Like, and going back to looking at trading in markets, you look for opportunities. Where are the anomalies? Things typically revert back to the norm.
To the mean.
Back to the mean.
That's value investing. You're trying like
that's value investing. Is it? It'll revert
investing.
back to the mean. So if you can find things outside of that right now,
buy $1 for 70 cents. That's kind of the classic Ben Graham, Warren Buffett sort of thing. And then usually, the market will sort itself out and value will be realized. And if you can value those sort of out, and that's exactly it. And that's
it's probably good. It's probably a good point there because say you're spending $750 purchase price in Melbourne at the moment, you're probably buying $1 million asset.
Yes.
So you are buying $1 million for $750K.
Well, yeah.
It's just how long it will take to actually revert to where it should be, and that should be, $750. That should be a median sort of price property in Melbourne. I think in Sydney now it's about 1.1 is the median price in Sydney. So you're probably buying at that now. Is it going to turn into that tomorrow? Probably not. But over what time period, and therefore what capital do you need in order to hold that property into a point in time where it's going to start realising that value?
Yeah, and that's a big problem when it's good. So in 2021 there was a bit of a peak in the Melbourne market and prices have come down. So if we look at, say, areas like Point Cook, which has had a bit of development, so that was kind of trading at about a median of 900, and that came right off.
That's a regional town, right? Point Cook.
Yes, it's just a bit of
nowhere.
Middle of nowhere. Yeah, population's almost is bigger than Townsville, I think, in Point Cook. But it just goes to show, sort of, prices have come off, and so the Melbourne median's already undervalued, and some of these areas have had bad times. Sunshine West, and like all of these suburbs, haven't done so well, but eventually it's going to go back to where it is. I think around that financial crisis time, when you look at Sydney, the places you were talking a second ago about Manly coming off, but I remember Mossman coming off quite badly in 2008, 2009. And there was an opportunity there to snag a bargain, if you could call Mossman a bargain then. But yeah.
Well, I'm getting told now it's a good time to be buying in those areas. If you bet your entrance price, I think to get into Mossman, you're looking at about $5 million just for just an entry level house, right? And I tell you what though, if you're buying, like, you talk about property investing and typically you're talking about the sort of more affordable quartile. A lot of property investors, and I would say now I'm not investing in the sort of bottom quartile stuff with my property investment. It's sort of
You got to that next level.
the next level, right? Which is just what happens when you invest in property. If you're able to buy and hold property in Mossman, like I tell you what, you'll find people all day long to rent that.
Yeah.
There's
People want to be there.
But people want to be there.
Yeah.
Families, 4 or 5 bedroom houses, investment properties in Mossman. I don't know how many there are, but there would be quite a lot, right? No, people need to live there.
Well, yeah.
And if you've got cash to deploy, and maybe you wouldn't want to be holding them at, you're probably not going to get the yields on it if you're borrowing at 80%. But
no,
if you want to
indeed.
park some cash.
Well, if you've got that disposable cash, might be better areas to do it, but they'll still perform very well.
And that is the point, right? No doubt these are the conversations you have. You go, why would you buy one house in Mossman when you could probably deploy that same capital and get 6 or 7 in maybe like many 3 or 4 in Melbourne.
Well, in Melbourne, yeah. Well, if you had that money, you could put that in, like as we talk about, a block of units in a decent location as well, where you're getting a decent yield, which and all of those.
So how you going, Matt? And this comes back to what you're doing now as a buyer's agent. It sounds like you've found your happy place. Doing this.
It's nice working for yourself, and but it's really looking for those win-win scenarios. Obviously, I want to grow the business, but I also want to sort of help people build wealth and do the right things. I know the levers to pull, and I introduce them to the right people. But it gives me quite there's a lot of information out there. I mean, there's never been more. But back then we had your magazine in 2010. Now you've got a lot of podcasts, a lot of social media,
so many podcasts.
And some pretty scary stuff actually coming out there. So trying to just keep it simple and get rich slow is something I talk about a lot. It's not a long term, you kind of overestimate what you can do in a couple of years, underestimate what you can do in 10. So get people set up with good portfolio strategy, good assets in good locations before, and getting in at the start of that cycle. So that's why people have done so well in Perth,
And sort of question, you said looking at a place in Newcastle off market, like how are you finding that stuff? Because that's like gold dust now, trying to find, apartment blocks for sale.
Well, they've obviously done very well in the last year or so, and there's been a couple of people out there who've demonstrated their deals and done well, but it's all about those relationships with agents at the end of the day. If you're doing some sort of volume and you can actually sort of pick it apart, there's a number of things. There might be an out of area agent who hasn't priced something correctly, but if you can generally pick it up before it comes to market, then you've got a good opportunity, and that's obviously what we'd be doing in Melbourne. There's obviously the portfolio construction is massive, but if you can make money going into the deal, that's sort of the organic growth to come is the cherry on top, so to speak.
Yeah, and I imagine there's probably quite a lot of 3, 4, 5 block apartment stuff in Melbourne, which would be pretty attractive, right?
Well, there is. I mean, you've got to be a bit more careful in Melbourne. There's quite a few more high rises in the CBD. Obviously, Docklands is a big no go, but those sort of areas where you're kind of in the southeast, every now and again there might be somewhere that comes out. Obviously, Frankston, we've been told that there's been a couple of decent opportunities I've seen there recently. Hyatt around those sort of areas that's quite close to Cheltenham. Every now and again, those lovely old sort of brick buildings come up.
That's what I'm talking about.
They could be strata titled. So they do come up from time to time. Yields maybe not as good as Sydney, but they can be.
Good thing is you're controlling the land, though. If you own all the apartments, it means you control the land.
Yeah, exactly.
And as in if those things get rezoned, you can do stuff with it or keep what you got and improve it.
And there's obviously a lot of rezoning that's happened in Sydney and in Melbourne at the moment. So Melbourne, we've got 20 neighbourhood activity centres, and so Frankston, Broadmeadows. I won't go into all of them. Preston, a few others. But if you're close to a station there, already some rezoning might have happened. And if you're in a block of units and the cash flow is not too bad, you're sitting on a bit of a gold mine. I think it's the housing and transport zone. So there's 2 schedules. There's Schedule 1, you can build up to 6 levels, and Schedule 2, 3 levels. So and then in Sydney, obviously, you've had that rezoning within 300 meters, I think.
It's gone crazy.
A load of stations.
Yeah. It's a lot, and yes, a lot of places have been rezoned, but you've got to do something with it, and building houses is pretty tough. I do note, though, that there's a lot of Japanese money flowing into now or being attracted to build to rent.
Okay.
Here in Australia, which was that they quite like.
Yeah.
Like that sovereign sort of Japanese dough. They like build to rent. So I'm seeing in the background there's a lot more discussions emerging around it, which would give an indication towards if a lot of foreign dough is starting to thinking about build to rent here in Australia, that would be some indication on maybe the economics of building are starting to get more favourable. So very, very early days.
Yeah.
But
I wish
to the
that.
point being, if you're controlling sort of 2-3 assets like you have up in Logan Lee, developers may start knocking.
Well, I think they will at some point.
Yeah.
I mean, it's a part of the cycle. We know that kind of the building industry's been decimated over the last 2 to 3 years, but we need properties built here. But if you've got that overseas money coming in, it's going to be interesting with what's happening with Trump's tariffs. It might be more kind of feasible for Australia to start dealing with other countries a little bit more and attract some of that investment into the country. So it's pretty exciting.
That'll be handy. Well, I've spoken to lots of buyers agent, but I think you're probably the only buyer's agent I spoke to who's been born out of sort of financial markets. And I would imagine that would appeal to a lot of people who are sort of wired that way. So, you've gone through the rigor of probably contrarian investing compared to your peer group in real estate and property. But I like the way that just I imagine it's an innate thing, looking at property investment as a portfolio construction type logic. It makes a lot of sense.
Well, yeah. I think, as I said, if you can make money going into the deal and then you've got that organic growth and you get into the right market at the right time, it's a bit like if you look at the stock market and what happened in 2008, obviously everyone knows there with the GFC, the market was down about 60%.
Yeah. Imagine you wake up one day and go, I'm retiring today. This is my last day of work ever.
Oh, it's horrible.
And then that happens and you lose 60% of your wealth.
Horrible. And
people bounce back, but
people sell. People sell at the worst possible time. It will it took about 5 years to bounce back. We had the debt crisis about 2 or 3 years after that. So all the European countries were going broke, and then but it was extremely 3 years is a long time in investing when you haven't hit. And I think that's what's happened in Melbourne a little bit. They haven't seen. If you're buying somewhere in the yield and you're buying at 2-3% yield, you're leaking cash flow. You've seen the price go down. You're going to tap out at some point, but that's usually the worst time to tap out.
It usually is. So it's one of the great things about property. It's a little bit harder to sell, right? I sold some shares yesterday. I just quickly went bang, bang. And it was done in, sold at market. It was done in 5 minutes.
Very liquid. Yeah.
Very, very liquid. And I sat there and went, no.
But property.
Harder. But it's good, Steve, mate. I really enjoyed the chat. I like the way you're thinking about things with portfolio construction, and that would be a sort of key takeaway for everyone to be thinking about their portfolio like a fund manager would think about the way they deploy their capital asset allocation. It's a really good logic. Good logic.
Yeah, I think that's it. And I think the other thing is working with that good broker, whether it be Finney, whoever it is, to kind of map out a plan. But now the game's changed a little bit. The one big negative to sort of buying in Melbourne, and we know the yields are around that 4%. Like if you're getting in around that sort of 650 to 750 level, a little bit lower if you go higher. So if you get one or two of those, the negative cash flow after tax is maybe about 12,000 per property. And so if you want to get to properties, say 4, 5, and 6 from a portfolio construction part, you do need a bit of cash flow to sort of offset that, and that's where you can work with a broker or a strategist to do that. So those assets that do provide a bit of cash flow, you're talking a unit. Everyone's a contrarian investor, but the real contrarian play is buying units, and no one wants to do that, like in Sydney and Melbourne. But that's a good play. But then also looking, if a lot of people in Sydney obviously have had great growth in their house, and there might be an equity put into a commercial asset, which then can offset sort of the negative cash flow for the two Melbourne properties. So really getting that right mix, so you can keep. It's like chess, trying to get to the next level. So important these days in scaling your property portfolio.
Yeah, it's good. So if people want to track you down, Steve, what's the best way to find you, mate?
So I suppose I should be more active on socials than I am, but I'm not. But propertystrats.com.au is where I am. Yeah, that's good. And happy to have a chat anytime.
So that's STRATS.
Yeah, yeah.
Strats.
So it comes from Goldman again. So when I was there, we were called strategists. So kind of nickname was Strats. And so I thought, well, what name can I have? Everyone's got property, God knows, whatever it is. Yeah. So Property Strats, there you are.
There you go. Find it, propertystrats.com.au. Go and check it out. Steve, thanks for coming down from Brizzy to come and have a chat with us today.
Ah,
Head
loved
back. It's a bit cold down here today, so
yeah, I know.
It's get back up north, mate.
Yeah, I
Much
know.
better.
Well, I'm a Pom, so I'm used to it anyway. But
Where are you from in England originally?
Reading.
Oh, you are from Reading.
Yeah.
Okay.
Yeah. So the old office with David Brent. That's kind of close to where I grew up. So
Okay. I nearly, thankfully, I didn't. Nearly got a job in a pub in Reading when I was a backpacker. Fortunately,
the Rock Festival.
Yeah, we did.
Get ready for that.
Yeah,
That was
we stay well away from it. But no, thanks, Steve. Thanks for coming in. Thanks for tuning in, everyone. Remember, smartpropertyinvestment.com.au or social media. Just track us down. You'll find us, like us, and please keep the reviews coming wherever you're tuning into this. Really appreciate it. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.